Chris, thank you very much for being here today. Pleasure speaking to you. We are here in Madrid today, trying to understand a little bit more about the Spanish market, where the opportunities are, the trends, and the risks as well. But before we go there, can you introduce yourself to our audience and WP Carey as well?
Sure. Thank you for having me. It's a pleasure to be here today. Very briefly about WP Carey, and I'll keep it really, really short. We are a New York Stock Exchange listed real estate investment trust, a REIT. It's basically US public capital that we invest worldwide. We have investments at this moment in 25 different countries, the majority of which are in Europe. So it's 20 countries that we cover out of our investment office based in London, where I'm based. And I head up the European investment activities. And together with my colleagues and the great team that we have, we really oversee our European investment strategy and try to deploy capital on a long-term basis as efficiently as we can. And maybe about WP Carey, some headline figures. The company was founded in 1973 by William Porker Carey. We've been a public company since 1998. We've also been investing in Europe since 1998. So actually have now a 27-year track record of investing in Europe, which is somewhat unique in the context of a European diversified REIT, that we have this long track record of being an investor not just in the US but also on the European side. And the strategy that we follow is reasonably straightforward to explain. It's all about long-term income generation and capital preservation. So we basically invest in real estate and with the intention to own it long-term, to be a long-term landlord, a long-term tenant, landlord and partner to our tenants. And the primary way how we create these transactions, how we create these long-term tenant-landlord relationships, is through sale and lease back transactions, which is nothing much more complicated than a arrangement whereby we acquire the property from a tenant and simultaneously lease it back to them. It's a form of capital raising in a way, or liquidity generation for those businesses, which they can then deploy into paying down debt, into M&A activity, into a new business venture, whatever it might be. So it's a form of capital raising, essentially, a kind of corporate finance transaction for those parties that we work with. In exchange, what we receive is the real estate as collateral in the transaction, and that long-term lease agreement, which hopefully we can keep renewing and so on and so forth. So that's the simple fundamental premise. Try to generate long-term, steady, inflation-protected income. And yeah, that's what we've been doing now as a business, we've been doing this now for over 50 years.
Good, very clear, very clear. You have exposure and you see 20 different markets. You have been doing deals in so many markets here in Europe. When you compare Spain to the other markets, what's good, what's bad, what's ugly, what's interesting about Spain? How do you define this market for someone who's watching us and is an investor, an institutional investor that would like to penetrate Spain, or is a local player as well, trying to understand how you think?
It's a good question. I think, what do we like about Spain? There are many things to like about Spain. The food, the weather, the people, they're all fantastic. So those are big standout points why we love coming back to Spain for new investments. And maybe I understand your question, and the question is a very valid one as to how do we differentiate between different countries and what might be a reason that Spain stands out versus France or another jurisdiction. But the truth is that fundamentally the business model that we follow is one that follows, in the first instance, the approach of diversification. It follows the approach also of the type of transaction that we look for. So for me, the jurisdiction, the country, as long as certain baseline criteria are met, like you need to have, obviously, it needs to be clear that you have a rules-based environment from a legal perspective that you can enforce on your leases. You need to have lease enforceability. You need to have a certain stability in your market. You obviously need to have a certain currency that works well, and so these kind of baseline things need to be met. But beyond that, fundamentally, we can go pretty much anywhere, right? So the sale and leaseback as a transaction is exceptionally portable between jurisdictions. So at a certain level of abstraction, the actual micro-location or even macro-location or even country decision becomes less relevant. So that's a really complicated way of saying we're happy to go wherever the deals are. We're happy to go wherever we feel at that point in time we can generate in a particular jurisdiction on a particular deal an attractive risk-adjusted spread relative to our cost of capital. Now, it's quite interesting actually for us sort of taking this high-level view on it, because it may mean that in 1 year we do 4 transactions in Spain. And right now we have several projects under exclusivity in Spain. It might mean that next year we may not do a single deal in Spain, right? But maybe we have several transactions instead in pick a country, right? So it's very sporadic. It's very at a high level of abstraction. And we're very, very laser focused on the type of deal that we look for. So it's this sale and leaseback situation that's really the core product that we provide and that we look for. And we go where the deals are. So it's actually rarely a conversation that we have, oh, are we overweight or underweight Spain? Are we overweight or underweight from an allocation perspective to Germany? Or pick any country. That's rarely a conversation. In fact, it's not really a conversation we're ever having. So it's a bit of a different approach because many investors might start from a allocation by asset class where they say, we want to have X% of our portfolio in logistics. And then maybe as a second layer, they might decide based upon a geographical allocation. Of that, we want this allocation in Spain, this in Italy, this in Germany, and so forth. And then they might shift their allocations over time and then rebalance their portfolio accordingly. We don't do that at all. It's more like, where can we find sale-leasebacks? Where do we feel that at that point we're getting a good spread relative to a cost of capital? Then we're happy to go there.
Interesting. Now, one of the things that investors like a lot is to feel they can predict what's going on, some stability.
Yeah.
Who doesn't like that, right?
Yeah.
Having said that, we first had COVID, which was a nightmare. Then when we felt everything was calm and okay here in Europe, after COVID, we had a war against Russia and Ukraine war. And then when we felt that maybe we were going to have something, more stable again, Israel and Hamas, the issue going on there in the Middle East.
Yeah.
And now Trump is here and he's making sure that there is not one day like another. How do you navigate in such an environment?
The way you just explained that, I mean, the question I have almost for you is like, do you see a pattern here? And the pattern is the instability is the only thing. The only thing that's still stable is instability, right? The only thing that's certain is uncertainty. And go back further in time. Before that, we had Brexit. What would that mean for the European Union? Before that, we had the Eurozone crisis. At this moment in time, Spain is going through a very, very strong phase of economic growth and development and is one of the fastest growing jurisdictions in Europe, and people are very upbeat about the economy. Have we forgotten that, again, not that long ago, Spain was the S in the PICS, right? When we talked about Eurozone crisis, we had the great financial crisis, the GFC, the Eurozone crash, we had the European sovereign debt crisis. Again, in the entirety of my working career, if you will, I do not remember a period of 2 or 3 years where there wasn't a crisis, there wasn't an issue, there wasn't a reason to be nervous about something. That has proven to me like the thing that is constant over time is that there's always a reason to be worried about something. Now, from our perspective, how do you invest in an environment where you are inherently uncertain about things? You should focus on the things which you can control and focus on the things which you can account for in your underwriting and try to mitigate them. And how do we mitigate risk? How do we mitigate uncertainty? Fundamentally, a key element, a key way how we do this is by signing very long-term leases. So from an investment perspective as a real estate investor, a big question mark that you might have is like, is the tenant going to leave? Are they going to stay? We try to reduce that risk and just push it out as far in the future as possible by having the longest possible leases. And then the second risk becomes, okay, what happens if my tenant might not make it? What if that building becomes vacant? That's where the credit underwriting comes in, where we are very, very focused, and the core competency that we have as an investment team, even though we purchase real estate, is actually not in the real estate underwriting fundamentally, it's in the credit underwriting. The team that I work with, their background is in private equity, is in investment banking. It's not a real estate background. So the credit underwriting piece is a key element to it, to make sure we work with companies where even when there are tariff issues, there will always be issues, that we feel we have the kind of companies in our portfolio that will make it through these ups and downs and through these cycles. And then we try to make the lease as long as possible. So again, we push that, what we would call like the residual value risk, as far out into the future as possible. Now, to allow you to do that, you need to have a platform that is set up to actually handle that. And that's great. The form that we are as a REIT, as a public listed company, we are basically a form of perpetual capital. So we own the real estate on our balance sheet, And we provide liquidity to our investors by being a public company. So an investor can buy a share of WP Carey when the stock market opens and later on decide to sell it. But fundamentally, the portfolio itself it's not a decision that's fundamentally driving the portfolio question fundamentally on a day-by-day basis. So we have the ability and we have the luxury, it's really a luxury of time on our side, that we can take a long-term view, we can buy an asset and we can hold it and keep collecting income on it. And that's how we mitigate those risks. It's taking a long-term view, long leases, long-term ownership of assets is the fundamental business plan. So we don't need to sell. We don't need to generate liquidity by selling an asset. We provide the liquidity at the level of being a listed company. And yeah, that's how you really do it. And that's how you keep investing also when times are difficult and you don't get distracted by the news cycle. There's always a reason why it's a bad thing to invest, or just try not to get carried away and try to find the signal within the noise, essentially.
Challenges. If you had to pick one challenge to nominate in front of you that you have for the next 12 months, what's your main challenge right now?
I would say there's so many layers to this question. Main challenges, I would say at the moment, I'm very optimistic about our investment pipeline. I'm very optimistic about how we are currently, let's say, able to price deals within the market and where we stand from a competition and competitive perspective. I think that doesn't give me a lot of headaches. I would say maybe something that could become a problem more is if there's a big shift in the expectation of the trajectory of long-term interest rates. It sounds like a complicated thing to be worried about, but fundamentally, if there's a big expectation that we see a material reduction in rates, it may mean that it builds up a certain hesitation for sellers to proceed, and that just may slow really down the activity in the transaction market. So that could be an issue. So fundamentally, what I'm talking about is interest rates. That's clearly as a long-term focused investor, and as an investor that is focused on the spread that we generate relative to benchmark interest rates, that's generally going to be your number one concern to be looking out for.
And going back to the previous question, I think if our generation is used to this kind of crisis and ups and downs from quite some time, one thing that was new for the real estate market or for some of the leaders now is that we have been operating under a very low interest rate for maybe a few decades. And I can sense from the GRI members that was a very tough moment when we need to actually to be with this high interest rate. But your expectation, do you see the interest rates going down? When you read the reports, it looks like it's going down, but would you bet your money on that?
So I think there's several things to factor in. One is, you're totally right. There's plenty of people out there today in the real estate industry and I think we're past the point that people have acknowledged that rates have gone up fundamentally. They have. I mean, this is already 2-3 years ago now. But prior to that point happening, there's plenty of people in the real estate industry that have never experienced an increase in borrowing costs. It's always been downhill. And you're completely right. It is a fundamental step change in how people think about maybe their exit assumptions and think about their how will they likely generate liquidity in their portfolios if they wanted to sell, because this idea that rates just keep coming down and keep compressing simply didn't prove out to be the case. And that's clearly, I think, one element to the story. But in terms of the second thing is, there is this almost obsessive focus on short-term borrowing costs and like base rates and how base rates might move, and whether the central banks, the ECB, the BOJ, the BOE, the Fed, are they going to change base rates? But really, I find that always, frankly, I find it misplaced, because if you're a long-term investor, there's a lot of it is about asset and liability kind of duration matching, as you want to call it, from a technical perspective. And so if you buy a long-term asset, real estate, you should match it with a long-term liability from a funding cost perspective. So it's not really the base rate that is the thing you should be looking out for. It's the long-term cost of funding. So maybe your benchmark should be more like a 10-year swaps or a 10-year bond or 10-year treasuries or something like that, where that's really a long-term cost of funding proxy relative to owning a long-term asset, where that match needs to be considered. And very often I kind of miss that part of the conversation entirely from a conversation where there's a laser focus on short-term borrowing costs and base rates, but forgetting that what we're talking about is a yield curve, right? So there's a term element, there's a time element to the cost of borrowing. It's not just on the short term, it's really the curve, the interest rate curve, right, as it moves out. And how that is moving, is it inverse, is it normal sloping, et cetera, I think that's really what the conversation should be focused on, rather than just on the short-term level. So we could, for instance, have a situation where short-term rates do see a cut, right? So if we have a somewhat more challenged economic environment, that central banks are compelled to lower short-term rates, but that does not necessarily mean that long-term rates will also come down, right? So this is not this. We're not talking about the same thing here. So that's just one element, maybe to just point out here, that the focus often is a bit misplaced on the short-term side of things. And then maybe the final thing that I sort of think about in this context is the real estate industry as a whole. Sometimes we have this obsession about lower rates is better. If the central banks would only cut rates, that would be that would save us from so many headaches. Lower rates. Why does a central bank lower rates? Well, it's usually in response because there's some economic problem that it's compelled to lower rates. So does it make sense to hope for lowering base rates when that is typically the consequence of a much weaker macroeconomic environment? It's like saying you're hoping for a recession because you think you'll be doing much better in whatever you're doing, because then base rates will be lower. Again, I find that connection very weird sometimes, how it's taken totally out of context, so that the hope for lower rates is in a way like you're hoping there will be a recession. Is that really what people are hoping for? Again, kind of concluding here my thoughts on this, but long-term rates, that's what really should be looking out for. And be careful what you wish for. If you're hoping for lower rates, do understand what that implication is and what that actually implies from a macro perspective, because that will also be a big drive on for instance, rental growth. So if you're saying you're hoping for low rates and high rental growth, but hold on a minute, if it's a recession, do you really think your rents will be growing all that much? So again, I think sometimes these things tend to get picked out in isolation rather than try to see them
all together.
Yeah.
Perfect. Chris, thank you very much.
Pleasure.